Let's get some insights in the news shaping the markets. For that, we welcome in Ben Emons is here, Chief Investment Officer, founder of FedWatch Advisors. Thank you so much for being with us. Wow, I mean, good timing on your part, because what a week we're having thus far. Can you give us a glimpse at yesterday's market reaction and what you thought about it?
Yeah, it was certainly a news reaction, as in, we got the news out of DeepSeek that they're able to generate these same ChatGPT for lower costs, and I think it was a wake-up call, as President Trump says. I think it was a good point about this price competition here that we didn't really price into these mega cap stocks, specifically Nvidia, and then obviously as that Nvidia gets a correction, which is as sharp as it was in the March of 2020, when we had a similar sort of drop of 18%.
Yeah.
This time around, obviously, Nvidia with its weight in the index has a far more substantial effect on the stock market than it had at that time. So I think if I step back from it and I say look at a more macro point of view, then we're going to get more price competition in the chip space. It's going to change the outlook for profits for these companies. Interim, it does mean that there's going to be pressure at times on the index itself, given the weight of these companies in the index. And I think this is the macro factor to the economy. Is AI now becoming such an influence on the economy that because of the swings in the stocks, outlooks change for inflation and the Fed, and also I don't think the Fed will react to this event per se, but they're having their eyes on it, because if it does go on, then financial conditions could tighten. That could impact on economic activity. So it is actually a bigger picture too, as just a microcosm of DeepSeek versus ChatGPT and all that discussion.
What do you advise to folks and clients? I mean, when you think about this, could be a volatile time. We're going to wait to hear from the Fed. Look, there's like a 99% likelihood the Fed's not doing anything, but the language will be important. You have a slew of tech names coming out. I mean, huge earnings this week and next. What are you telling folks?
Well, this event showed that you really have to start thinking about diversification this year. That sounds
right.
Simple, but it really is now of the essence, because if you have such a move coming from a few stocks, and it's been warned for over and over that this could potentially become a problem, I do think that folks need to think about other sectors to try to diversify around this particular technical effect of these Nvidia and other type of stocks. As to the Fed, it's more about, they're going to talk about the economy is strong and all that, but they know that there's vulnerabilities here, not just this event in terms of the tech sector, but also what's going to happen with trade policy and the uncertainty thereof. So we're entering, I think, into a somewhat more uncertain period, and that just emphasizes a more defensive, diversified portfolio.
So at this point, I mean, a name like Nvidia, does it still belong? Was that a big opportunity yesterday? I know you said be more diversified, but a name like Nvidia, for example, yesterday was at $117. Was that a big buying opportunity?
So if I listen to Dan Ives, and I think he has great calls, he says it's a golden buy opportunity. I think he probably is right for those who have been not as much invested in Nvidia, and this is an opportunity. But if you are, you may just want to not necessarily add more to this risk than it already is. I think you need to be careful at least. I mean, the company itself is doing exceptionally well. I don't think this is the nifty 50 idea of at the 70s where macro factors change and suddenly high-quality companies really start to climb. But I don't think we're in that stage here yet, but it just shows that it can cause significant volatility. There was a statistic out yesterday that the last 10 sort of market cap adjustments were all caused by Nvidia. So it just underscores the concentration risk of the market.
Right. Tell me a little bit about the market overall. I mean, there were plenty of people who were calling for a pullback regardless. I mean, they felt like, look, last week we were hitting new highs on the S&P 500. The Nasdaq's still not far off from its all-time highs, right? So you are still relative after 20% years on the S&P 500. I mean, there were people who were still predicting more growth this year. Do you feel like, look, at one point we were oversold, but maybe not so much, and especially if you look at something S&P 500, for example, tell me a little bit about where you think markets are and what they may do.
I do think that there's still a good case for more upside. I do think that the plans of this Stargate investment that they are doing, which is, I think, a really serious project, that in itself could have meaningful impact on the economy and therefore drive earnings and growth for the index overall. So I do think on that basis, seeing an S&P at 7,000 at some point is very likely. And I think that's and maybe also because we're getting more and more rotation within the index, which has been happening. You know, if you think of staples or materials or financials, even energy, it have been more in a rotation trade compared to tech. I also think that the sectors, by the way, that are driven by this AI investment, like utilities, electricity, and heavy equipment, those will continue to be in demand. I think those companies will very benefit from this change of cycle to an investment cycle. But when it comes to volatility, this is a year, I think, of more volatility than last year. It's also different than the first year of Trump in 2017. We had a very low volatility environment. And that's really because we got everything here up front, right, in terms of the tariffs, in terms of this news. I think that people are uncertain, so the volatility level will stay higher, I think.
Okay, and also, you know, we are always watching the 10-year bond yield. You are watching the range of 4.5% to 5%, and say use the TLT as a hedge, particularly against the Mag 7 volatility. Tell me a little more about that, what you expect from bonds and how you can use, for example, the TLT as a hedge in your investment place.
Yeah, I think that the idea of that you have flight to safety that starts to happen each time the Mag 7 has volatility. And I think yesterday's was a really good example. It probably will repeat itself again because people will seek then a quick liquid alternative. What's not better than to take a TLT ETF as that? It may also somewhat relate to, and this is the somewhat discussion that's happening, is that what happened yesterday, could that be a risk to economic growth in the US? If that is, TLT will be a hedge for that. So I think for that reason, the range of 4.5%, 5% will probably stay intact, but TLT will be an opportunity there each time we're getting a little higher yield, and then the volatility happens in tech stocks. Okay. On the other hand, I do think you want to be cautious with being overweight TLT because that too has not worked really well. We have continued to see TLT trade lower and lower in price, right? So it is, I think, a tactical hedge against tech volatility.
All right. Good to see you. Ben Emons is here. Thank you.
Thank you.
First time I think we chatted in 2025. Thanks, Ben. Good timing.